Hey, Russell Lamberti, thanks for joining us again on the Beleidsradar. Today we are discussing the Sakeliga ETM quarterly report, which have recently been released, and we're looking at the economy. Russ, help us make sense of the economy at the moment. I think maybe one thing we can talk about is a word that you used, is the notion of an ugly boom. Please explain to us.
Yeah, Gerhard, good to be with you again, and with all your viewers and listeners. This concept of an ugly boom is I suppose a phrase that I've just come up with to describe a situation where central banks and governments have poured money and debt on top of this economic crisis that we've faced as a result of lockdown. So countries were locked down. There was initially the beginnings of a financial crisis as a result. Banking systems nearly went bust. Many businesses have folded. Millions of people have lost their jobs. And what governments did to compensate for that is they printed loads of money. They borrowed loads of money, very often from the printing press. So money has been printed up overseas, not as much in South Africa, but that has taken place. The other big one is interest rates were slashed very, very hard, benefiting people who are in debt, punishing people who are trying to save and earn income from savings. But what that has created, what those low interest rates, all that debt, all that money has created is a kind of boom scenario where we've pumped easy money into financial markets. Stock markets are going up, housing markets are going up again, and there's kind of like these boom-like conditions for certain households, for certain groups of people who have managed to keep their jobs, who are connected to the financial system, who can access capital, who know how to play the system. For those kinds of people, this generally feels very, very good and very, very easy at the moment. The conditions are very favorable for those kinds of people. Then, Gerhard, there's a whole lot of other people who are in desperate situations. They've lost jobs. They are suffering from in the worst case scenarios, hunger and poverty. Probably about 1.5 million people are unemployed compared to this time last year. That's a huge number. They each support maybe 3, 4, or 5 dependents. So you're talking, 6, 7, 8 million people very directly affected by this crisis that we've lived through. And for those people, life is incredibly difficult and getting worse in many ways. And so that's why I call it the ugly boom. Some people have called it the K-shaped recovery. One leg of the K is going up and other people are kind of going down. And there's this widening gap of wealth and inequality and so on for, I think, very unjust reasons. So that's why I call it the ugly boom.
Russell, that's interesting. I think just thinking back to March, April, May of last year, we all had this sense that this is quite a serious event and that we are looking at some, maybe even a collapse scenario in certain sense of the economy and of economies. Now, as you said, some of the Western governments overseas in North America, Europe, so on, have been very accommodative in terms of monetary policy and things. How is that affecting South Africa at this point?
In some ways, when big central banks and governments overseas do what they do, print money, go into more debt, that creates, in a sense, an indirect bailout of the South African banking system and the South African economic system. A lot of money starts, because so much money gets created, a lot of that money starts flooding back towards emerging markets, into South African bond markets. Foreigners are buying our bonds. In other words, they're lending to our government, which actually allows our government to continue to run up huge national debts and spend far beyond their means. So there's now I actually think that's a huge problem. It may stave off a fiscal crisis in the short term, but it's enabling an chronic addiction to debt by our government. So this happens, this money comes in, and it just prolongs the deepening of the ultimate crisis, I think, because South Africa goes more and more into debt. Also, printing money, borrowing money from the future to bail out the present, or borrowing it from your capital base, really, to sort of bail out businesses and incomes and households, is really a short-term strategy. What you're doing is you're undermining your long-term prosperity. You're undermining the capital base. You're undermining the real wealth base that's been created that needs to be around to produce future income. And you're consuming that wealth base. That's really what's going on. And now people are going to start seeing data from a number of countries that shows that the GDP losses from 2020 weren't as bad as they could have been, or as some people thought they were going to be. And they're going to judge this as a sort of a good thing and a victory for some of the policies that have been put in place. Look, we locked down, we saved lives, and we were able to print money and borrow money and sort of boost the GDP number. And all this means that we've kind of gotten away with we've gotten a free lunch in a way. And I think the big catch here, the big problem, is that what countries are doing is that they are damaging. If you think about it in company terms, they're damaging their balance sheet to improve their income statement. Okay, GDP is very much a national income statement, an income flow. The balance sheet is not really included in GDP, and it's your capital, right? It's your savings. It's the things that make you able to earn income. And if you consume capital, if you damage your balance sheet, if you over leverage your balance sheet, if you raise liabilities and reduce assets, everyone knows that over time, if you don't put those liabilities to productive use and thereby create new productive assets with them, if you just consume those debt liabilities, you're undermining your fundamental productivity for the long term. And I think, Gerhard, that's what's really concerning here, is we are consuming our asset base that undermines long-term growth.
Yes, Russell, now moving to South Africa, taking what you've said now in context of the State of the Nation address that we just had, and that President Cyril Ramaphosa also spoke about what he called reforms. But from our take on that is that we can't really see any market-driven proper reforms of the economy being evident. There statements have been made about things like the employment equity and race-based policy even being expanded and more strictly applied. So in a sense, we have the global picture, which is supporting South Africa in the sense of accommodative policy. Do you think all these things are related in a certain sense, and how?
You're absolutely right in your question. There's no real reforms that have been announced. What we've gotten is commitments to really trying to extend social welfare grants and payments to people. We've got talk of deepening, as you say, BEE and various other regulations and licensing regimes. There was some talk of energy sector liberalization. We're so desperate for energy freedom in this country that I'm not sure it's going far enough. I'm not sure it's doing enough at this point. I think, I hope that in the next few months, the dam wall bursts there a little bit, and popular sentiment prevails that anyone can produce energy, and we sort of get a liberalization of this energy market, because it's desperate. It's very, very crucial. There's unfortunately, though, just no real sign of true reform. There's talk now of minimum wage regulations, I believe, have now actually come in at a time when we've just lost 1.5 million jobs on a semi-permanent basis. I mean, some of those jobs are clawing back, but we might sit, Gerhard, with about 1 million people unemployed on a sustained basis compared to last year. Additional people, that's over and above the 6 or 7 or 8 million people that are already unemployed. Just an enormous enormous problem. And I actually think that the SONA, the State of the Nation address, was a shameful event, Gerhard, because what you have is a president standing up pretending that things are not so bad, talking as though the ANC's got things under control and that it's going to make some good decisions, and that it's sort of not too bad. We're in a deep crisis, and people want the president to be honest, to be truthful, and to tell it like it is. And of course, we don't really have that, and we certainly don't have anything that we could consider truly meaningful reform. One of the things we do in our report, the quarterly report with Sakeliga, is we produce the presidential policy scorecard. People can look at that; they can find that on the final page of the report.
Yeah.
And we've used 10 important sort of sets of data, and we put them into a score out of 100. So each set of data gets a score out of 10. 10 times 10 is 100. If you get 100 out of 100, you're doing excellently in terms of policy, in terms of economic outperformance, and all these good things. You're getting investment, you're doing all these things. So we're tracking policy as best we can with real data. So the government can say all they want, but is reality changing on the ground? Are they actually making a fertile environment for investment, and so on? And what we find in the presidential policy scorecard at the moment is it's sitting somewhere roughly about 3 out of 10 or 30 out of 100, which is a fail. It's not a good position. It's actually deteriorated in the Ramaphosa era. And we try and adjust for external problems like lockdowns and coronavirus and all that sort of stuff. So even adjusting for that stuff, we're still in a really bad policy environment, Gerhard. And until we see this chart meaningfully going higher and real things happening on the ground, I think we must take a lot of what's said at SONA and the stuff with a pinch of salt, and certainly all the stuff about building a new city and a smart city and all this. We can discount that stuff and really focus on some of the real stuff that's happening on the ground.
Yes, Russell, just some comment from my side. What I found interesting and shocking in a way is actually the statements of government expanding government and public sector employment. That's quite a difficult thing to think about in terms of the fundamentals of those, even with the state's wage bill at this stage, how difficult it's going to be just to curtail that, and now words about expanding that, quite concerning.
So obviously the immediate question is where they're going to get the money from.
Exactly.
The idea that we can expand the public sector is just sort of crazy, and the idea that the public sector can continue to be a driver of employment. I mean, the public sector has been the main employer, the main driver of employment for the last 20 years, certainly the last 10 years. And it has to have a limit. There has to be a limit to how many people can be employed by the state. One thing they can do is they can shift the spending within the budget more towards employment. And you sort of get the feeling that that's where this is all going, that eventually the government is basically going to be an entity that collects taxes and just dishes them out to a few million employees and 20 million or so grant recipients. And you could have as many as 3, 4, 5 million state employees at some point, and you could have 20 million grant recipients, and you've got 25 million adults in South Africa that are basically being supported directly by the government, which of course becomes a very powerful voting mechanism for the government, and so on. But so they could expand public sector employment if they diminish all the other kinds of spending on procurement, on maintenance, on all these things. So you get just this bloated employment, but the actual state infrastructure kind of just falls apart. The difficulty, of course, as well, is that they're going to have to then cut spending to to say for tenders and for procurement and that sort of stuff. And that's going to put people's noses out of joint who have been benefiting from that patronage network and from those channels of funding. So all in all, these are just promises, and one does get the uneasy feeling, Gerhard, that the more these promises are made, the higher the expectation of destitute people is going to rise. And it's going to be very difficult to avoid for the government to avoid going for funding to the central bank, to money printing. And then, this is a topic that I talk about a lot, and it's something that we've got to be very, very cognizant of and careful of. The minute we go towards that money printing route and we start printing money to hire people, to hire people for the state, to pay tenders and all this kind of stuff, we're going to go into a very, very dangerous scenario. And I'm not saying that that's imminent. The Reserve Bank continues to be well managed. It's one of the reasons why the Rand, and we talk about this in the report, why the Rand is firm and is actually holding up strongly. So it's not a short-term scenario, but these promises and these obligations of the state are building up, and the funding side is under real strain, and that down the line could lead us into a money printing scenario. We've got to be very wary of that.
Russell, and I suppose another question from my side is, any other highlights in the report that you'd like to point out to listeners and to Sakeliga's members that you found interesting and that you think is important to take note of?
Yeah, Gerhard, I suppose there's a few interesting things going on. The one is a piece of good news in a sense, from a fiscal perspective. So we've been talking about this very bad fiscal situation, and it is bad. The one thing we've seen, though, is a very rapid improvement in tax revenues from the depths of the economic decline last year. Now, it's not entirely clear how sustainable this recovery is, because there's still a lot of unemployed people, but many of those unemployed people possibly are below the tax threshold or don't pay very much tax. So as businesses have recovered, as the economy has opened up, life carries on, trade happens, production happens, there is money changing hands and trade happening. Taxes are going to improve, but they've improved quite a lot more rapidly. So the deficit for the fiscal year that's about to end is not going to be as bad as it may have been in first estimations, but it's still very, very large. It's still enormous. We've compared to the deficits we're running, it's huge, and it's very, very destructive. And we've added hundreds of billions of rands onto the national debt in 12 months or in 9 months. So, but that's been quite interesting. So that's evidence of the economy opening up, of the fact that, employment, incomes, these things have recovered from the very worst part of the lockdowns. I suppose my expectation is that those tax revenues, having recovered sharply, are perhaps going to soften off again. We've had softer economic conditions in December and January because of this level 3 lockdown. The world's gone into greater lockdown, so trade flows are under pressure. So that's something that I'm watching closely. How are these tax revenues going to respond? I suspect they're going to soften off again. So we've seen a recovery catch up from the depths of the crisis, but now I think there's going to be some softening. So I think that's interesting. Another interesting one is vehicle sales are struggling to recover. So we've got very low interest rates. Housing markets are doing well because interest rates are low. Cars are financed almost entirely on debt. The car sales are stabilizing at about 85%, about 15% below where they were pre-COVID. That's interesting. That might speak to less travel, less mobility, people using their cars less. So that's just an interesting trend for people to watch out. The vehicle market has not recovered easily back to its previous levels. So those are some of the important things I would say happening domestically. Two quick things globally is that we are starting to see the US economy, the recovery from lockdown, starting to slow down a bit. the job market is flattening out at about 12 million people fewer employed than this time last year in America. So in other words, 12 million people have lost their jobs on a sort of more permanent basis in the United States. That's a huge number. And so some of those recovery dynamics are struggling, you can see. And then the other side of things, China, generally, if I look at Chinese data at the moment, kind of seems to be okay, even though global trade has been under pressure. So China seems to be doing something right. It's not easy to believe all of China's numbers, but some of the data that's reliable shows something reasonably resilient. So the big picture overall, Gerhard, is there is a recovery from the depths of the lockdown last year. It's not going to carry on forever. It's going to start flattening out now as we move into the first part of 2021. But business conditions, as our indicator shows it in the right at the front of the report, our business conditions indicator does show an improvement. And that is some good news. There's some sense in which things are slowly normalizing, even though we live in a world of lockdowns and restrictions and fear of COVID and travel restrictions. These are still all in place in many instances. But there is a greater opening up, and I think that speaks to what we're seeing in the numbers, which is just better economic conditions. And I suppose people can take some heart from that we are not lingering in the worst of what we experienced last year.
Yeah, indeed, that is good news, Russell. Now, I think just to conclude, and we always try and do this, to give some thoughts about corporate strategy, what businesses should be doing at this point. Obviously, we cannot tell a business owner how to run his business, but some ideas, Russell.
Yeah, we cannot tell people how to run their business. They know that far better than us, Gerhard, and you and I have spoken about this often. So we want to give the kind of advice that is in our sphere of sort of understanding. Look, I think the first thing is just to be aware of lockdowns and the ability for governments to reinstate lockdowns. And I think probably what people have to think about is as we look towards winter. So winter is about, 3 months away or so, 3-4 months away. I think we might get a reprieve as the second wave of COVID infections and deaths has started to tail off. We get a reprieve through the course of February, March, April, May, potentially. But there is always a risk as winter comes along. We saw this in the Northern Hemisphere, that you get this rise again of respiratory illnesses. So people need to be aware of the risk of additional lockdowns, but not imminently, I don't think, towards the middle part of the year, and just try and plan accordingly for that. If lockdowns, dramatically affect your business, they're not behind us yet. There's still a psychology that amongst governments and amongst many people that lockdowns are legitimate and a viable policy option. So we just need to be cautious of that. Exactly. People need to be aware that the rand is resilient for a few good reasons. I won't go into all that now, but basically the Reserve Bank is managing itself pretty well. The dollar is weak, and the dollar has generally been weakening. Commodity prices are doing well. That generally supports the rand. So the mining sector is doing a bit better. When the mining sector does better, manufacturing and logistics do a bit better. So the rand is on the front foot, and I don't think likely to be dramatically weaker in the short term, and is probably fair value to the dollar at the moment at 14.50 odd, 15 rand. So that's just something for people to get a handle on who have currency exposure. Interest rates are probably going to be fairly stable for the foreseeable future. I don't see the Reserve Bank particularly inclined to cut much more, but they certainly don't want to hike rates quickly in such a fragile environment. So your interest rate environment is likely to be fairly stable for the time being. And then, of course, stuff that is ongoing in the background. People must be aware of the threat of expropriation bills and and various policies like that. But Sakeliga has that stuff very well covered, and people are generally aware of those threats. So it's not like there's anything very new there. And then I think in terms of opportunities, we've said, lockdown restrictions could well lift globally and domestically between February and June. That's what I was talking about, this little window. This is a trading opportunity that must be used to the full. Commodity resilience also stands to benefit South Africa in mining and logistics. So guys, commodity prices are doing quite well. Under the circumstances of a weak global economy, commodity prices are up, and they're suggestive of scarcity. They're indicative of the weaker dollar, the money printing that's going on. So commodity prices are inflating. That's quite supportive for South Africa and mining and related industries. So people need to be aware of that. And I think as a result of all that, to finish on the more positive stuff, we are seeing better numbers in the retail sector. Some of the retail companies on the stock market are trading a lot better. Their prices are going up, and financial services as well. Because of low interest rates. Low interest rates often mean lower earnings for banks, but it also means they're able to extend credit. They're able to create credit in the system, lend more, and generally maybe not do very, very well, but be protected from the sort of worst case scenarios. There are still risks for the banking sector, though, in commercial property. Commercial property is still a very, very difficult sector. People are vacating office space. A lot of cities are sort of emptying out a little bit. People are working from home more, and that is hurting the commercial property space, quite a bit more. So I think those are some of the areas that people just need to be aware of, and you got to think about some of these big picture dynamics in relation to your business. If you need to take on more debt funding, at a variable interest rate, you're probably okay for a while with low and flat interest rates. It's something you could probably handle. And if you've got certain kinds of currency exposure, you probably need to be aware that the rand is fairly resilient and just about fair value for now. I don't see any imminent big risks to the rand right now. So these are the kinds of things businesses can take on board into their own corporate strategies, Gerhard.
Russ, I think that's good. I think we can leave it there unless you want to add anything else at this point. But I think that's good.
Lovely.
Good insights. Thanks for the opportunity.
Yeah, thank you, Russell, and we'll talk again. Thank you.